Markets are rallying today after last week's sell-off, but is the rebound sustainable, especially with growing scrutiny around AI-related spending and return on investment? Chad Larson, Senior Portfolio Manager with MLD Wealth, joins us now to unpack it all. It's good to have you in studio. Thanks for joining us.
Thanks for having me today.
So what do you think matters more when we're looking at the earnings season, headline beats or actual credible guidance?
You know, I think it's less about beats and misses and more about guidance, credibility. We started in a marketplace of what I think it's a transition between what we're calling like prove ROI versus an infinite TAM. And that's jargon that we use. Like TAM is the total addressable market. And that's something AI for the last number of years, everyone's like, it's going to be huge. And I think the reality is it's how big the opportunity could be. And we know it's big, but now it's prove ROI. It's prove the return on investment. And we saw that with Microsoft earnings last week. It's a big company to be down more than 10% in one trading session. I think that's the street really looking at show me the money component. Is structurally the trend still intact? It is, but now it's more structured and staged. So I think one of the things we saw over the weekend with NVIDIA pausing a little bit and maybe putting a bit of a damper on the potential $100 billion deal with OpenAI is it's still happening, but it's going to be staged and prudent. So some more calmness or pragmatism is coming back into the marketplace.
Do you think that seems to be a concern as we head into 2026? Is that like the potential for overspending when it comes to these companies kind of spending on AI and trying to get things off the ground?
Absolutely. I think, we're all kind of, drinking the Kool-Aid, so to speak. Right. And we look at the Meta and, NVIDIA and Google and this big spend out. I think the number was closer to $390 billion was pushed out last year in CapEx. That's the equivalent of government stimulus into the marketplace. That has meaningful impact. So we know the party's going, it's all happening, but it's going to be this show me moment. And I think that's on the durability of consumer demand and some of these like AI taxes that are coming in, like really looking into Apple's earnings is the cost of memory is coming up significantly. Yeah. And so is the consumer, are we going to be as durable to these increases in costs for the increases of compute power and the critical minerals that go into this? Yeah. I think what Donald Trump is doing is prudent, and we're seeing that scarcity theme play out in the marketplace. It's not just about technology. It's going to be about the things that go into them to make them happen, whether it's copper, whether it's critical minerals, rare earth metals, whether it's going to be the data distribution, the power lines, all of these things are going to play into it.
Sorry, I didn't mean to cut you off there. Another big company we're watching for this week, Palantir. Is there anything in particular you're watching for with this company, especially when it comes to like gauging real commercial AI demand? Absolutely.
Like I think Palantir's earnings are the litmus test of the narrative movement. It largely is traded on momentum and excitement into what's happening. But we really need to see like increased order books, recurring demand, increased order log books. Is the hype real? Are we able to scale the consumer into this? So we know the investment's going to come and there's going to be that backlog, but is the consumer there?
Another company, I know you touched on this already, Apple, of course, reporting earnings last week and talking about, warning customers that prices are most likely going to go up. When it comes to that cost increase that we could see with Apple, for example, where do you think that comes from? Like, is that tariff related? Is that like AI related components and materials like copper and stuff that you need for those?
That's a great question. I think it's all three, and two things can be true at the same time. Yeah. I mentioned kind of what you're seeing as an AI tax is all of the input costs that go into this. They're becoming more expensive because more dollars are chasing them. That's basic supply demand. So the input materials that are going into them, are becoming more expensive. So how do they push that down onto the consumer? And will you and I, as consumers, remain durable in the face of increased costs for our hardware to access our softwares? And the next choke point that we're seeing is going to be largely on power. And I think the AI boom is really an industrial boom dressed up with a tech label. I think the scarcity of the rare earth metals, the copper, the electrification story, and the power is going to dominate. And I think that's the choke point into this next phase.
Well, you wonder too, like where customers' patience is going to run out if you're paying higher prices for everything. People obviously don't want to do that, right?
Yeah, I think the customer is going to be very durable. I think I look at I turn my phone off for the interview, but the cost of my cell phone now is is probably more expensive than the laptop I use at my desk. It's become critical infrastructure of how you and I engage in everyday life. So I think the consumers will remain very durable, but it's going to be this show me market. It's going to be when does the investment turn into cash? I lend you money, no problem, or I invest in you, no problem. And I think what's happening, and I'll go back to Microsoft, I know you're going to pay me back. I know I'm going to make an economic return, but when? And I don't think the market's frustrated yet, but I think the duration and the time for that investment to turn into real cash flow and earnings is probably a little longer than people expected.
Okay, going back to the markets as a whole, another thing we're watching for today and watching is the price of gold. We saw it plummet on Friday. I think it was the lowest plunge that we've seen since in
83.
a decade. Yeah, okay, since 83.
Yeah.
What do you make of what we're seeing with the price of gold? Should investors be worried, or is it just like a blip?
Listen, structurally, I would say, like, as of last Friday, I'm very exposed to gold. So Friday wasn't lovely, but I think I saw the best way, and I think, he or she who tells the best story wins. And I've made a career out of making the complex, seem more simple. But, there's a Matthew McConaughey meme where he's driving the Lincoln, he's handsome, and he's cruising on the open day, and it said gold, $4,800 an ounce. And then it was Matthew McConaughey and Dallas Buyers Club, like looking disheveled and falling apart. And it's like gold at 4,800. Yeah. Things have gone so well. I think structurally things got a hold of themselves. There's a lot of margin, speculation. One of the gentlemen that works for me showed me a picture in our local market of people lined up outside, a store where they could buy physical precious metals. So things swing too far in either direction. But listen, the analogy I would make is, I'll bring it back to the oil markets. Mm-hmm. If we had $150 oil right now, it would be, amazing for an oil company. So it corrects to 130. Who cares? Gold just ran so fast structurally from a scarcity geopolitical standpoint, a debasement trade of the Fed against a weaker greenback. We saw Trump, nominate a new Fed chair, Mr. Warsh, and has typically been more hawkish. But this has been 10 steps forward, 2 steps back. So being worried today, again, and that's why sometimes I always hesitant to talk about earnings. Mm-hmm. This is a moment in time. Is the cycle and is the structure make sense? And I think gold will remain strong, but obviously have a lot of volatility. Things move up too fast.
Yeah, for sure. Okay, well, that's all the time we have. Appreciate you coming in. Thanks so much. That was Chad Larson, Senior Portfolio Manager at MLD Wealth of CG Wealth Management.